Hey guys, this is Chris Mancola with the Mancola Group over at West USA Realty, and I'm doing our weekly housing market update. So here's our report. I'm going to go ahead and share my screen and jump right into this. Okay, whoops. Let me get okay. So we see that the key on inflation drives mortgage rates, which kind of drives supply and demand, right? Because people are worried about how much they're paying for things. So key Fed inflation gauge rose 0.3% in February, which was less than expected. So this is a good sign. Year over year inflation, we're starting to see that come down, believe it or not. Not to say that there's no inflation, obviously, again, rose, but less than expected. We're seeing a slowdown. And we saw this coming, and we are telling you also to watch out for May 10th and after in June, July, and so on, because we're going to see that. And it's always a long lagging effect. I mean, it could be months before it kind of catches up. We're going to see that year over year shelter costs, which makes up about 42% of the actual inflation numbers. Okay, we're gonna see that coming out about May 10th. It'll all get caught up. So when they make their announcements then, but we're starting to see this happening now. We're seeing that personal spender index, including food and energy, increased 0.3% for the month. And the Commerce Department was reporting that this was good news because it was a lot less than expected. One of the things I wanted to mention on that along those lines is, and I think I showed you this article before, but mortgage rates down the lowest level since early February. Okay, so we see, usually, when there's issues with the economy, rates drop. There's issues with the economy, rates are starting to drop, starting to play catch up. Okay. Shortly thereafter, rates drop. So a lot of times when people are having issues in the stock market, they'll run to the bond market, but both of them having issues. So here's what's going on here with these interest rates. Also, with that in mind, bonds ultimately improved today due to a flight to safety in the broader market. In other words, investors sold riskier assets like stocks, bought safer assets like bonds. Excess bond buying results in lower rates, all things being equal. And, the whole reason for this collapse, besides some poor business practices, let's just put it that way, is that, and going back all the way to, modern monetary theory, that's a whole nother story, but that the Fed's fund rate basically made it, harder for banks to, deal with what they had before, which was like zero interest. And then it was really hard for them to take care of those investments. So that by the Feds, Jerome Powell and Janet Yellen, who really made a mess of things, in my opinion, and a lot of people's opinion who kind of watch this stuff, they are trying to tame inflation for what they're doing. It's definitely, that part has definitely happened. I think that they're overdoing it. They've been overdoing it. But that said, and that doesn't affect mortgage rates directly, but indirectly. But basically, when they raise these funds rate, your credit cards cost more. You go to buy a car on credit, it costs more. All this stuff, to get credit costs more, and then it indirectly affects the housing market also, and loans there. But this, so there's kind of a difference there, just to make sure people realize that. I don't spend too much time on that, but anyway, home sellers' willingness to offer concessions in this article, waivers with mortgage rates. So in other words, mortgage rates are coming down, so there's more demand. Okay. And we're going to talk about that right in a minute here with what's going on in the local Phoenix area and countrywide. But, as rates drop, there's more buyers. As we get into busy season, there's more buyers. So sellers may be a little less apt to do what they were doing a month or two or three ago in offering your closing costs or buying down your rates and stuff like that. Now in the Phoenix area, we're still seeing about 47% that are paying that. But keep in mind, I've been warning people about this. Get ahead of the curve now. Okay. Because we're going to see rates really start to drop in May, June, July. But if you buy now, you get the lower price and you kind of skip all the extra competition and all the nonsense, and you can always refinance later. Okay, no out-of-pocket costs. And if you're getting concessions and you're doing one of these buy down programs, your money's sitting there in the escrow that the seller paid for, and you can actually use that to pay for your refinance later. So yeah, we got preferred lenders that can go into that in more detail. But anyway, this Fed hikes rates, home sales beat expectations. So home sales are doing just fine. Everybody was talking about it's going to crash, going to crash, going to crash. We're not seeing that, and we're not seeing the foreclosure numbers, which I'll talk about here at the end. But you know, they did raise the rate, the Fed fund rate, by 25 points. Okay, so just again makes borrowing money a little tougher for people, a little bit more expensive. They need you know, to kind of slow that down. I think in about 3 to 4 months we'll see them actually not only backing off, but they'll probably start talking about or getting into lowering those Fed fund rates, but we'll wait and see. Existing home sales strong despite media reports. Yes. So existing home sales rose 14.5% from January to February to a 4.5 million unit annual pace. And ending the 12 consecutive months of decline, sales were 22% lower than they were in February and last year, though this is less than nearly 37% decline we see in January. And of course, year over year, last year was crazy anomaly year. So, you know, we're in more of a normal market now. We're in a very normal market now. So, you know, bottom line, one big thing here to note, and it talks about the real appreciation data per latest Schiller report showed that home prices were 5.8% higher than a year earlier, which is fantastic, right? I mean, that's still a great pace. So people still, you know, haven't lost equity. They probably got equity, you know, from their earlier home purchase. But in addition, there were 980,000 homes available for sale at the end of February, up from 850 a year earlier. However, this inventory increase is from a record low level overall, so supply is much lower than in a balanced market. Now, for us, you know, during the crash, it was about 58,000. Countrywide, it was over 3 million. You know, for us, a normal market here in, you know, across the country of homes for sale, to keep up with the new, you know, household formation and all that, is going to be about 1.2, 1.3 million. In Phoenix, it's going to be, you know, a balanced MLS supply for us would be around 30,000 homes for sale. So we're way off from that. Right now, we're sitting right at 13,000 for just active all property types and the Phoenix metro area MLS. We are at 13,929 right this second. Okay, so you see that there. So in other words, you know, supply is still very low across the country and in the greater Phoenix area. This has kept things stable. Okay, so the chief economist Lawrence Yun noted that inventory levels are still historic lows. Consequently, multiple offers are returning on a good number of properties. So across the country, the number thrown out this past week was 2.7 offers for every home for sale. So again, we're going into busy season, going into spring season, spring and summer, normal, and we're starting to see rates come down. So of course, that's going to increase people's you know, need or want to move on and or purchase a home in the first place. Okay, so just sum this up: signed contracts, new homes rise for the third consecutive month. Jobless claims, and the reason why this is important, the claims reflect a tight labor market. That means, you know, they were taming inflation by late to the party, not doing, you know, a lot of policy issues that are making things a mess. But suffice to say, and a lot of the numbers that we were getting at the beginning of the year were kind of old numbers that were kind of rolled in, and seasonal stuff and all kinds of part-time jobs, maybe about half of those. So guys, in reality, as far as what the Fed is doing with taming inflation and destroying jobs by doing that, and you know, you know, taming product development and all those sorts of things, so that there isn't crazy inflation that keeps going and going on to oblivion. That part, yeah, that part's starting to work. It's starting to slow things down. It has been, and they're going to be always behind the curve on all this stuff. So, but as rates drop, even though let's say a million a million or so people come out of the labor force, although that's never a good thing, and although there's still inflation, it's dropping. We're seeing that rates are dropping, and therefore 5 million to 6 million people can now afford to buy a home, or the home that they wanted to buy. Okay, even though it's more expensive. Not disputing that it's more expensive than it was a year or two ago, or a year and a half, 2 years ago, when rates were at 3%. Not disputing that at all. Okay. All right, guys. So let's get into that. But you can get a really good price on a home right now. Again, get those buy downs and move on. Right. So, also, when it comes to the Cromford Market Index, which I'm going to go into now, below 90 is a buyer's market, above 110 is a seller's market, and in the middle there between 90 to 110, 100 being dead center, that's a balanced market. So the market index today is at 134.7. That means we are in a seller's market. That's up 9.4 month over month for this week. Last week, it was up 11% month over month. And the week prior to that, it was up 12% month over month. That means it's still going up, but it's decelerating a little bit. Okay. And I think that we'll see that as things loosen up a little bit with rates, we're going to see those numbers kind of increase more. Is it going to be crazy like before? No. We were in the high 400s last year, or a year and a half ago, 2 years ago. So we're not going to see that craziness, but we should see a nice brisk market, normal market, where people are gaining equity. Demand is at 82, which we're seeing, there's more demand that's increasing, but the supply is still low. And these two things are also ruled a little bit by, a lot of people who maybe think, oh, I'm going to wait, when you really should be getting ahead of the curve so that you can get the better price on the home and get the buy down. But the supply, if you're somebody who owns a home, you're like, look, I got like a 2% or 3% interest rate. Why am I going to go out and get a, let's say it's 6% on a conventional loan right now with no buy down or anything. Okay. Even though buy downs can get you, near threes. Okay. Right around threes with a buy down program, that the seller pays for, by the way. But so that's why our supply, and also because builders, okay, and some of that gets canceled out, right? Because they're going to go buy a home. So that kind of, that's why we're seeing this 20-point difference or so between supply and demand. And also builders are ramping things up a little bit now, but they had kind of held off a little bit when rates went nuts, right? They weren't sure what was going to happen. So everybody's kind of looking for that May 10th date. Keep an eye on that as far as rates dropping. But when that happens, then you're going to start having the stampede, right? As rates drop and inflation drops, things become more affordable. Demand is going to go up. Okay. So as far as all of the cities are concerned, Tempe and Paradise Valley are both heading in a downward direction, specifically in those cities on the Cromford Market Index. -5 for Tempe, Paradise Valley's -16. Up overall, the highest change would be with Chandler at 24% up. They're at 222 on the Cromford Market Index. That's a really good seller's market over there. And then, as far as who's in balance, we would have Goodyear would be in a balanced market. And then Queen Creek, Maricopa City, and Buckeye are all in buyer's market, but trending towards, that balance and so on. So just to keep an eye, if I didn't mention a city, that means it's in the seller's market. So keep that in mind if you're a buyer or seller or both on what's going on out there. Of course, we can drill down more on that for you if you have any questions. But, you know, I wanted to talk really quick about foreclosures, and that is interesting because Crawford gives us some data points to go by on this. And I'm gonna kind of read some of this information. Below 5,000 foreclosures pending. So, trustee sale could be, whatever, 90 days out, let's say, typically, or whatever. So below 5,000 of these is low, okay, and not to worry, so to speak. Between 5,000 and 10,000 is normal, okay. Between 5,000 and 10,000 is kind of like the balanced normal range for pending foreclosures or trustee sales in the Phoenix area. One right now we've been running right around 1,000 to 1,200 range. Okay, so we're not seeing an issue. And they say, Crawford says, below 8,000 pendings for foreclosure, you're still good to go. But above that, we could start to be running into a problem. So as far as this big, sky is falling, chicken little, as far as we're concerned here in the Phoenix area, in the Phoenix market, we're not seeing that, guys. We're not seeing that. So again, if you have any questions about that, and maybe even for your local area, we're running CMA, and a market analysis for your area. We even like to show you maybe what's expired in the area, what, and these sorts of things that may be happening in your area. So you're just aware of what's going on, get a better sense of where we should set those prices at. So guys, I think that's all I have for you today. If you have any questions at all, feel free to reach out to us anytime. It's 480-788-8569. You can always email us at home@mincolagroup.com, or you can check us out at mincolahomes.com, mincolagroup.com, and make sure you get on social media. You can always subscribe to us over on YouTube. It's probably one of the best there, or Facebook. You can find us at Mincola Group. On Instagram, we made some changes. Right now we're running off my Instagram page, so it's just under Chris Mincola there, and I'll make sure we put all the links below. But I'd love to hear from you guys if you have any questions at all, would like me to kind of include in here, like the foreclosures this week. We had some of that. If you have any interest in your local area, want to know about buying or selling a home, you want to get linked up with a loan officer, we've got all that one-stop shop here. So guys, if you have any questions, feel free to reach out. Again, 480-788-8569. You can call or text us there. Thank you.